Hey, Leon, can you hear me? Hey, Leon, can you hear me? Or can anyone hear me?
Yeah, I can hear you. You're all
Awesome.
good.
Cool.
Okay, awesome. Well, welcome, Jean. And I want everybody to welcome Jean as well. Thank you so much for being here today. I really appreciate it, and I'm sure everybody else does as well. So once again, thank you for being here.
Great, glad to be here. Yeah, so Ernesto, what works best for you? Can I just share my screen and go into it?
Yes, absolutely. Let me give you a little bit introduction so everybody knows a little bit about you, and then you can go ahead and take it away. Sound
Awesome.
good?
Perfect.
Cool. So everybody, today we're hosting Jean Sung. She's an equity research associate at Capital Group, and she's had experience working at Morgan Stanley, Accenture, and Goldman Sachs before moving to become an equity research associate at Capital Group, which is a private firm managing more than $1.7 trillion in equity and fixed income assets for millions of individuals. So everybody, welcome her, and Jean, feel free to take it away. Thank you so much.
Awesome, thank you guys. Let me just share my screen. Great. Can everyone see my screen? Or Ernesto, can you see it? Great, awesome. Well, thank you all for being here, and it's great to be here. Maybe before I get started into my presentation, obviously today I'm here to talk about equity research, what it is, careers in the field, and sort of maybe where you can go after school into this industry. Just maybe like if you guys want to put in the chat, or Ernesto, if you want to give me a summary of the audience today, like how many people there are we college age? Are we college grads? Like what's our familiarity with finance? You guys can put in the chat, or Ernesto, you can give me a quick recap.
Yeah, absolutely. So in terms of the people that are here today, so there's a wide range of individuals from pre-grad, so undergraduates, graduated, and some are even in an MBA program, right? So they're even going to graduate school. So you have a wide range of people who are participating today who are obviously interested in the financial industry. So go ahead and take it away.
Okay, awesome. Well, here's kind of like the agenda of what I'm hoping to talk to you guys about today. And I don't want it to just be sort of a one-way lecture. I'm hoping to have you guys pitch in, think through questions with me. And if you have any questions, feel free to unmute yourselves and speak up. I'm happy to take questions live. So just as a recap of what I'm hoping to talk about, I'll start with introducing myself just a little bit. Ernesto did a great job, but I'll go into that a little bit more. I'll talk about really like what is equity research. It's a pretty kind of broad topic in term. I'll talk about really how research is done, kind of from my own experience on the fundamental side. I'll go through a little bit about kind of valuation, and I'm going to assume folks here have either like a little basic understanding of accounting, and it's totally fine if you don't. This is all pretty high level. And then finally, I'll wrap up on doing how to do a stock pitch, whether it be a formal, longer one or in an interview. And then finally, how to enter a career into equity research. And I want to leave plenty of time for you guys to ask me any questions. But like I said before, feel free to ask along the way. So a bit about myself. As Ernesto mentioned, I worked at Goldman for a couple years and recently was at Capital Group. Before that, I went to UC Berkeley, graduated the class of 2017 with a double major in business from the undergrad program at Haas and economics. I was at Goldman for a year or so after graduation, doing equity research on stocks in the services sector. So think of companies like H&R Block or Bright Horizons Family Daycare. So industries like that. After Goldman, I transitioned into my latest role at Capital, where I was there for about 2.5 years. At Capital, I was a research associate, so doing the kind of company analysis to help our investors. Capital is one of the largest active money managers in the world with an AUM of about $2 trillion. And my focus there was mostly on enterprise software stocks, video gaming, and Amazon. So a really cool coverage. In terms of where I am now, I'm actually on a little break from working. I am going to pursue my MBA at Harvard Business School this fall. And so glad to hear there might be some business school folks on the line. Maybe I'll see you on campus. Just starting off, like what is equity research? Really the bottom line here is equity research is the research or the analysis that drives an investment decision on a security or a group of securities. From my own kind of professional experience, I've only done equities, so single company stocks. A lot of folks find great careers in fixed income. That's really not kind of like what I'm going to talk through today, but have that in the back of your head in terms of what equity research can really encompass professionally. And so for those of you who may be, before heading into college or not super familiar with the industry, you might hear these terms sell side and buy side. I want to kind of go into, what is equity research in terms of what type of firms actually do equity research. So starting on kind of the top section is what folks call the sell side. And these are going to be basically all your major investment banks. So for these investment banks, these firms like JP Morgan or even Goldman Sachs, where I was, really the bread and butter of their business is investment banking. So, helping companies do mergers or IPOs, and almost all of them have sort of a corresponding stock research division. And what these firms do is they basically sell their stock research to asset managers like Capital Group or Wellington or Citadel. And that's kind of what is referred to as the buy side. So the buy side, how it differentiates from the sell side is they don't do investment banking. They don't help companies, IPO or merge. They actually manage funds, and they actually invest those funds in individual securities. So, this section of equity research firms consists of hedge funds, or what capital is as a long only. So asset managers that hold investments for a very long period of time. And when it comes to the buy side, most of the time, these firms are going to invest on company-specific information, what we call fundamental information, to drive those investment decisions. And the last kind of bucket that is way out of my realm are the quant funds. And so these quant funds are folks like D.E. Shaw or Two Sigma, and they are making investment decisions by very, complicated mathematical and statistical models that trade stocks based on trading data, macro or news data. So not really looking at the individual companies to drive those decisions. So if I kind of like recap the slide in one sentence, you can think of it as the sell side sells research to the buy side that actually buys the stocks. So I'm gonna just like stop here. Does anyone have any questions, or is anything confusing?
Nobody has had any questions in so far, so I think you're good.
Awesome. Great. So I'm going to shift gears a little bit into, how equity research is done. And this is, again, from only my experience, really, how do we think about, whether a stock is a good investment or not? Before you really go into any of the numbers, most kind of fundamental investors really start from analyzing the industry. So really the key question is, does this company that I'm looking at, or this stock, operate in an attractive market? And the kind of data we use is from kind of third parties like Gartner or IBISWorld or industry conferences. And we look at questions like, is the company's industry growing or mature? Who are the competitors for this company? Is this company in particular winning or losing share? How fragmented versus consolidated is this market? So this really goes kind of from top down to really start thinking about the investment decision for the stock. So, you guys can put in the chat or shout out loud. Can you guys think of industries that are secularly growing or declining? Like kind of, spit out some potential answers. You can put in the chat if you guys are, okay, awesome. Tech and crypto, awesome. And I saw a question about quant funds, something new. I wouldn't say new necessarily. They've definitely been around for quite a while, but I'm sure the capabilities of those firms have grown a lot. And when it comes to the perspective of fundamental firms like Capital Group, where we don't have those same sort of complex models, things like machine learning and training folks to be more data savvy is definitely like a big trend in the industry. But yeah, quant funds definitely aren't anything new. Awesome. What about companies, or sorry, industries in secular decline? These are some really good answers. So appreciate you guys pitching in. I can think of something, newspapers, print media, TV advertising. So those are some kind of frameworks we think about in terms of going from top down. Awesome, great. And then kind of the second tranche of research is really like the bread and butter. And this is going into the company level research. And I think at this step, this is when you're kind of drilling down into those numbers. And you're using this kind of company level information to build out financial models. So some company level research questions we answer are really, how good is this specific company based on its data or past performance? So we already looked at the industry. We kind of made a call whether it's good or bad. And now we kind of look at the specific company in question, because just because it's a good industry doesn't mean the company itself in that industry is good. So really the key things we look at this step are the financial statements. Is this company have high debt or leverage? How profitable is this business? Is it growing? Second are really important is the execution of this business. And obviously every quarter, if you're a public company, you have to report your results. And so as investors, we look at how have results been both recently and way back in the past. So you can pull earnings reports from the SEC website, from the company website itself, and those are really helpful to go through. And then something really interesting that I've done from a fundamental perspective is speak to former employees of the company and field experts. So you can find those on LinkedIn or through third parties, and those folks can give you information and insights about a business and its management team that you really can't find on Google. So that's a really powerful kind of source of information as well. And I think like as an investor, one of your best friends is these tools like SEC Edgar, where the SEC kind of has all publicly filed information on a company, including its quarterly, annual reports and any transaction information. And then a lot of folks in this industry on the institutional side will use tools like FactSet or CapIQ to pull a lot of kind of historical financial data about a business. And then I didn't include kind of the third part of research, which I think at Capital we really value. And the third part is really only accessible for very large institutional investors. And that is actually talking to the management teams of these businesses. So speaking to the CEO and the CFO and actually getting their thoughts on really the long-term outlook of the business and getting their thoughts on sort of the nitty-gritty as well as the financials. And that was a really cool part of being in this industry, is getting to interface with the C-suite of a lot of really big companies. And if you are interested in this industry as a career, that's one of, I think, the coolest parts of the job. So I'm going to go into the valuation section, but maybe before I kind of jump into there, I'm going to check the chat for any questions. Okay, great question. What is meant by secular growth? This is a good question. My boyfriend's actually looking at this PowerPoint. He was like, what does this mean? So it's actually kind of like an industry term, and secular growth is basically growth that is driven by very long-term trends. I think a good example is cloud computing, right? Like a lot of companies have an exponential amount of data. It's being fueled by the internet and mobile devices. It's really expensive for them to store all that data on their own. And so businesses like Microsoft and Amazon can capture on that growth that's going to last for a long time. Something that could be secular decline are malls. People are shopping online. People don't want to drive to the mall. So that's kind of what we mean by secular growth and decline. And then someone asked, is equity research the same as auditing or due diligence? It's also a really great question. I would say auditing, not as much. That is going to be kind of the big four accounting firms. So they're going into the financial statements, and before those are published, they make sure everything is correct and that the companies basically aren't lying to the investors. What is funny is that a lot of investors actually, form investment theses on certain businesses based on what they think are maybe inconsistencies or discrepancies in the financial data. Just because something is audited and it's reported doesn't mean that it's necessarily apples to apples. So for instance, a couple of years ago in the software sector, there was a big accounting change. And a lot of companies started spitting out these very unique, non-audited sort of terms. And on face value, they look really good to investors. But if you really dig into it, you're like, okay, what does this actually mean? So that's an interesting nuance to point out. In terms of due diligence, I think due diligence, equity research are pretty well aligned. I guess like for this one, due diligence is basically doing the research to determine, like what is actually true or false about this company. And yeah, we do a lot of that in terms of equity research. Like that's a big part of what we do. I think the big difference is that equity research takes the next step and makes an actual investment decision on the due diligence. The due diligence is the work that it takes to get there. You could do due diligence and not invest. You could be someone who is just working on a project, or you could be like an investment bank doing due diligence to help sell a company's IPO to various investors. So due diligence, pretty similar. Auditing, not so much, but really good questions. Let's see in the chat. Okay, there's a question about breaking into equity research. Does this require any experience like investment banking? I will get into that later on, but that is a great question. I'll keep that in the back of my head. Maybe we can stop there a little bit, and got another question about breaking in. I will definitely talk about that at the end, but definitely save those. And if I miss any, I have a Q&A section at the end. You guys can definitely ask me more there. Okay, so valuation. This is maybe a term you've heard of if you have taken finance and accounting classes in school, or you've tried to recruit for an investment bank or equity research role. So valuation is essentially, how do we determine whether we should buy or sell a stock based on its current stock price, and what is like the right price for a security? You guys have probably all seen, stock charts that move up and down all the time, but really, how do we compare prices across stocks, and how are we assigning a correct value to a stock is what valuation tries to answer. So there are a lot of different valuation methods. You guys may have heard of things like a DCF, a discounted cash flow, or relative multiples, or there are many things, but today we're going to focus on relative multiples just because it's probably the most relevant in terms of what I have had exposure to, and maybe more easier to understand if you don't have a super complicated knowledge of accounting. So back to valuation, like how do we compare security prices? So I've taken basically two screenshots, one of Apple stock and one of Microsoft stock. This was a couple days ago. Apple's share price is $145 as of a couple days ago. Microsoft was $287. Okay, those numbers at face value don't mean much. Just because 145 is lower than 287 does not mean Apple is more of a bargain stock than Microsoft. And what valuation helps us do is compare stock prices on an apples to apples basis. And I'll go into that a little later on. So when it comes to valuation, understanding really like the true monetary value of a business, there are two very important terms. And these are two ways of calculating the total value of a company. So the first term is equity value. And equity value is how much in dollars is the company or stock in particular being valued on the public markets today. You guys have probably heard of something called market cap. That's basically the same thing as equity value. And equity value is just calculated as the current share price of the stock multiplied by the total number of shares the stock has outstanding. So that's pretty straightforward. They're basically saying, if you bought all the shares of Microsoft on the stock exchange that are trading in total today, how much would you have in dollars? So the second important term is enterprise value. This also tries to calculate the total value of a company, but in a little bit of a different way. And this is more from a mergers and acquisition kind of perspective. And the enterprise value, the way I think about it is how much we have to pay to buy out this company. Like if I, as a large investor, wanted to buy out Microsoft and own its whole business, what would I have to pay for it? So the enterprise value is equal to the equity value, which I just outlined above, the market cap, and you add the total value of the company's debt that they have, and you subtract the total amount of cash they have. Okay, I'm just gonna let this sink in a little bit, okay? So this means that if I were to buy all of Microsoft, I would have to purchase out every single one of its shareholders, that's the equity value. I'd have to add the total amount of debt they have and subtract cash. So this might be a little unintuitive. I don't know who is familiar with kind of this terminology, but does anyone know why you add debt and subtract cash? You feel free to take a guess. I'll give a couple seconds and I'll tell the answer if not. So the reason why you add the debt and subtract the cash is you're saying, okay, if I want to purchase the entirety of a business, you have to buy out all the shareholders. You also have to pay off the company's debt that they have to all of its bondholders. So if the bank, loaned a bunch of money to Microsoft, if I wanted to own all of Microsoft and control the whole business, I have to pay off those debts. So that adds to the amount of value I have to pay to buy out the company. But I can pay off those debts with the cash. So the debt balance gets reduced by the total cash balance. And of course, you're getting these debt and cash numbers from the company's latest balance sheet filed with the SEC. Kind of the main difference I'd say between these two is obviously that debt and cash number and the enterprise value. So the enterprise value really considers how much debt burden a company has, and that's important for very levered businesses like chemicals, industrials, etc. Whereas equity value focuses just on kind of the stockholders. They don't really care about, the debt holders. Whereas the enterprise value takes into account everyone in the capital structure, AKA everyone who owns a little bit of the company. Let me open the chat just to make sure. Yes, debt is the same thing as bonds. And why cash? Why not all assets? So you're subtracting cash because most of the time, cash is really the only liquid thing you can use to pay off the debt. And yeah, that's why you're subtracting just the cash from the debt balance. Does preference share capital also form part of the same? Yeah, so preferred shares, that's a very technical, nuanced question. That's a good question. A lot of people include preferred shares in the equity value calculation, but it's usually not like a huge chunk of the total number of shares outstanding. For those who aren't familiar, preferred shares are typically not shares that you and I could just buy on Robinhood. They are shares for very early investors, and they give very, I guess, like privileged type of investors more voting rights in the company. But yeah, that's a good question for sure. Do you have any more? Yep. Okay, cool. Good questions. Does anyone else have any other questions on this? I know it's a lot to digest, but okay, cool. Moving on. Okay, so I want to give you guys maybe a little bit of an exercise. So what I've done here is I have the balance sheet for Salesforce as of the latest quarter. These numbers are all in millions. So for the cash, they have 8 billion in cash and 2.6 billion in debt. And then here we have the latest share price of Salesforce as of a couple days ago and the 10Q. So maybe just to start off, can you guys calculate for me, and you can type it in the chat or say it out loud, the equity value of Salesforce based on just this screenshot right here? And to go back to our definition, equity value is basically the market cap. So share price times total shares outstanding. Give you guys a bit to. Okay, well, if you did the math, that's fine. If not, that's fine too. Just a quick equity value is there 921 million shares from here, the income statement, times the latest share price, so $244. That gives you 224.7 billion is Salesforce's total equity value. So how much value in total stock they have on the stock market today. And I was gonna ask you guys to do the enterprise value, but you already see the answer. For the enterprise value, again, you would take the equity value above, so the 224.7 billion, you would add the debt and subtract the cash. And this 2.67 billion and 8.54 billion, again, come from the balance sheet numbers that you see here. So you can notice, guys, that if a company has a lot of cash, like a lot of tech companies and software companies do, they're pretty asset light, your enterprise value is going to be less than your equity value, which is an interesting kind of nuance to remember. Does anyone have any questions or comments on that? I had a question about, these are very technical. Does the debt also include contingent liabilities? Typically, no. When we think about enterprise value debt, it's mostly debt that you have to pay back to an actual bondholder. So that's usually going to be it's actually called debt on the balance sheet. So you can see for Salesforce, it's non-current debt, for instance. Okay, cool. So now we're going to shift gears and actually talk about multiples. So now that you guys have learned equity and enterprise value, what can you do with those numbers? Well, with those numbers, you can now compare security prices on a relative basis across multiple stocks using multiples. And multiples are basically a fancy way of saying ratios. So they're looking at the enterprise value or the equity value as a multiple of a certain financial metric, which could include revenue or earnings per share. So typically multiples are only helpful to compare companies across similar sectors, given that different industries have unique business dynamics and capital intensity, et cetera. So some common enterprise value multiples that investors look at include things like EV, or enterprise value to total company revenue, EV to a thing called Ebitda. And Ebitda is a short and fun way of saying earnings before interest, taxes, depreciation, and amortization. So you're basically taking the net income of a company, adding back the interest and the taxes and the depreciation and amortization. So basically trying to look at, what is the company earning before all those kind of like funkier charges that they pay at the end of the day. And then another unique one is Ebitda adding rental costs. And then some common equity value multiples, you guys have probably heard of PE. So PE is basically the share price divided by annual earnings per share, or EPS. Another common one we look at in the industry is price over book value per share. And book value is all the assets a company has minus all the liabilities the company has, and that leaves like what's left for the equity holders. I think I had a question in here. What is enterprise value less than equity value? I think I might have answered that just a little bit before. If I didn't, let me know. Basically, if there is a lot of cash, when you're trying to acquire a business, you got all that cash, then that is less for you to pay, because basically that cash goes to you if you're buying out the entire business. You'll see that enterprise value will be sometimes a lot higher than equity value when you look at companies with a lot of debt. Because remember, for enterprise value, we're adding that debt balance. And for companies maybe in industrials or the automobile sector, very levered companies, sometimes that really bumps up the enterprise value. So depends on a company by company basis, but a lot of firms in software will have that unique situation where enterprise value will be less than equity value because they have a lot of cash. Awesome. So I gave you I spat at you guys all these multiples. So how do we choose like what multiple to use? You guys have maybe heard about some of these multiples. For EV to revenue, you're going to use this a lot for companies with negative earnings or profits. So what kind of companies have negative earnings? A lot of software companies. If a company is not yet profitable, you can't use something like PE, because you're going to get a negative number at the bottom and you come out with a negative multiple, and that makes no sense. So you're looking just at kind of the top revenue number. EV to EBITDA. So EBITDA is basically a fancy way of saying how much is a company making before interest and taxes and depreciation. And the reason why you're not looking at interest, taxes, or depreciation is with a company that has a lot of debt, they typically have a lot of interest. And when you pay a lot of interest, you typically get a lot of interesting tax breaks, and that makes things a little funky. I don't know how familiar you guys with the term depreciation amortization. That's basically like saying when you drive a car off the lot at the automobile shop, it loses value immediately. It's not something you're paying out of your pocket, but companies from an accounting perspective can treat it as a cost. And again, there can be a lot of strange like accounting treatments across businesses. So we're not looking at that charge as well. So you're basically looking at the operating income of a business for this EBITDA number. And like I said, it's going to be used for a lot of capital intensive, cyclical companies, often in place of PE when the earnings are pretty volatile. So you'll see this used for telecom companies, metals companies, and EV to EBITDA. So that's EBITDA, also excluding rent costs. That's going to be used for hotel industries and transportation companies, just because that rent charge is a big kind of cost that varies a lot between businesses in that sector. When it comes to the PE multiples, so these are our equity value multiples. PE is a pretty common multiple. You see this used a lot to compare companies with mature, stable earnings. There's not a lot of funky accounting. So the E, or the earnings per share, is very dependable. So that's why you're comfortable using PE. And then the final one I'm going to go over is price over book value per share. And this is for companies with a lot of tangible assets, a lot of like hard tangible stuff on their balance sheet. So financial businesses have a ton of cash. That's a big part of their business. So you'll see this metric used a lot for banks, manufacturing companies, energy companies. So these are kind of, this is not like a hard or fast rule, but I would say if you're in this equity research role, you're going to see probably EV to revenue a lot. If you're in a software covering sort of role, which I was in, EV to EBITDA is pretty common, and I think PE is pretty common. So these are kind of the more typical multiples that I've seen throughout my career. And then I think I have some questions. Would this mean it's not smart to use PE for Tesla? Sure. Yeah, that's pretty fair to say. I guess it depends, because maybe some investors look at PE in a future basis. So they say, okay, maybe Tesla isn't profitable today, but I'm going to look at the PE if I go forward 4 years and think of what Tesla's EPS is in a couple of years and think about it that way. So that's an interesting way to look at businesses on a PE basis that are not yet profitable. Let's see. Why do these multiples standardize evaluation across the given industry? I guess they don't really standardize evaluation. It's more just a way to compare the stock price across companies in an industry. So let's say for EV to revenue, if I calculated this number for all software companies I'm looking at, I have a very apples to apples way of comparing how much I'm paying per dollar revenue. So how expensive a company's stock truly is, rather than just looking at the stock price itself. Could you share your experience when you compare PE, EPS of a company with industry and market? Yeah, I don't know if I can answer this question well, so feel free to follow up with me one-on-one. But when I compare the PE and EPS of a company with the industry, tools like FactSet have really cool ways of doing that. You can actually like plot valuation, comparing a certain company to a group of companies and to the overall market. So there are very digital ways of doing that. It's pretty handy, but yeah, I think again, these are helpful frameworks to think about when it comes to the multiples. But in the next slide, I'm actually going to go into potentially the shortcomings of multiples. So just as a little exercise, if we go back to our Microsoft versus Apple example. So here I have the kind of financial data from Microsoft and Apple, and you can use these exact numbers to calculate the PE multiple. It's just going to be the share price divided by the earnings per share, which is 35 times for Microsoft. And for Apple, you do the same thing. It's 28 times. EV to revenue for these two companies, just plug and chug the numbers. It's going to be 12x for Microsoft, and for Apple, it's going to be about 7 times. So again, these multiples are saying for PE, you're taking the share price over the earnings per share. So that's saying, okay, for every $1 of earnings per share that Microsoft generates, if I bought the stock price as it is today at $287, I'm paying $35 for each $1 of earnings that Microsoft is generating today. And same deal for Apple. So just from like the numbers alone, Apple, just based on the multiples, is cheaper on both PE and EV to revenue than Microsoft. So this goes back to someone's question I just had, thinking about comparing the PE and the multiples of a company with similar ones in the industry. So you see, just from the numbers alone, Microsoft looks more expensive. And if you hear on the news, folks like Jim Cramer talking about valuation, getting expensive or cheaper. This is typically what they're talking about. They're thinking about multiples. So we have these multiples in mind. And we determined on the last slide that Apple is more of a bargain than Microsoft based on just the multiples alone. But what I've done here is I've given you guys kind of the financial snapshot of Microsoft versus Apple. So you might be thinking, okay, you know, Apple's cheaper than Microsoft on multiples. I should just buy Apple. Like, why would people pay more money for Microsoft? So just looking at these two snapshots, like, why would that be the case? Like, why would the market assign a higher multiple to Microsoft versus Apple? They're two pretty good companies. They're both based in the US, both tech companies, both, you know, great history. Like, why is the market paying up more for Microsoft? Again, you can type in the chat or you can shout it out loud. Yep, that's right. Profit is higher. Yep. Forward earnings. So great future earnings potential. That's a great answer. You know, if the market thinks that Microsoft can earn more in the future than Apple, which someone mentioned Microsoft is a more profitable business because they're not selling hardware. That could be why investors want to pay more for Microsoft. That's a great answer. Another one could be that you guys didn't point out yet is Another mentioned Microsoft's diversified product base versus Apple being a purely kind of, you know, mobile only business. Another thing is Microsoft is just growing faster than Apple. Microsoft probably has less regulatory risk as of now, less kind of geopolitical challenges than Apple, especially over the last couple of years. So, you know, when you look at multiples at a face value, again, not super helpful. You got to go deeper and ask, why are the multiples the way that they are? And if you ask that question and it still doesn't make sense, that's where we see investing opportunity. And that's really the whole point of equity research. So jumping into that, going into relative multiples and applying this to an investment thesis. So again, we got our PE ratio for Apple. We calculated a couple slides before, the EV to revenue multiple of 7 times. So let's say Wall Street analysts think Apple's EPS next year will be $6. The latest year it was $5, but you think based on your own research and your own diligence, it's going to be $7. If we think the market will continue to value Apple at a 28 times PE ratio, our EPS would put the fair value of Apple stock at 28 times your $7 estimate, which gives a share price of $196. And that's a 35% premium to where Apple's trading now. So basically, if you're right and you know, all these things kind of fall into place. If you invest in Apple's stock price now, you're going to make a 35% upside in a year versus the street's fair value of Apple. So again, when I'm talking about the street, I'm talking about Wall Street. A lot of analysts on Wall Street, AKA my old job at Goldman, publish their reports. They kind of put out their estimates as to where they think companies are going to earn or grow in the near future. And that's what I mean by the street. So if all the other Wall Street analysts think it's going to be $6, that means that their implied fair value price for Apple is $168. So your 196 versus the 168 for Wall Street, that means you have a differentiated view. And that would imply that if your thesis goes correctly and everything falls into place, you would have a unique buying opportunity versus what the market is saying. So that's how we're kind of applying multiples to our everyday work in equity research. Let me see, just check the chat for any questions. I don't see any. Okay, just some final thoughts on multiples. I think I covered a lot with you guys. Again, while multiples are a pretty helpful way to compare stock valuations, they boil down a lot about a company into one number. And so again, if we go back to the Microsoft versus Apple example, if you look at just those multiples, you're oversimplifying a lot of things about those businesses. And like a lot of you guys pointed out in the Q&A, multiples only reflect the present, nothing about a company's future potential, which is what we care about as investors. And then something I did mention was, you know, multiples, especially with something like PE, that earnings per share number, that can get manipulated or skewed by accounting differences between companies. And As an equity research associate or leader, you got to really be on the lookout for that too. So those are just some final thoughts on multiples. I'm going to go into the next section of the sample stock pitch. So before that, do you guys have any questions or comments? I don't think I saw any in the chat, so I'm going to double check, make sure. Okay, no, awesome. So a stock pitch. This is going to be really helpful for you if you're in an investing club in college and you're doing a competition. And especially going to be helpful if you want to go into this field and you need to do an interview and do a stock pitch in the interview, which is like 99% guarantee you're going to have to do. So how do you do a stock pitch? Well, basically, I think of the stock pitch structure and flow into sort of these 3 steps. First is your executive summary. You start off with like, here's the stock I'm recommending. Here's my price target, what I think the fair value should be, and the implied upside or downside if you're recommending a sell on the stock. Second is the industry overview. So we talked about that early on and how we do equity research. What industries does company operate in? Where is the company within the industry? Like, is it a leader? Is it losing, etc.? And what's going on in the industry? So then you're going to dive into the actual business. What does this company do and how does this company make money? And is there any recent significant developments for the company? And then I think probably the most important part of the stock pitch is the investment thesis. So are you recommending a buy, a sell, or a hold on the stock? And what are your 3 thesis points for your recommendation? This is like the key. So the next part is like the catalyst, like what events will shift the stock price in the direction of your thesis. So catalyst could be things like earnings, if the company is going to be acquired or buy another business, product launches, macro news, etc. And then you're going to kind of end the stock pitch with the valuation part. Like, how did you get to your price target? And what's kind of your bull, bear versus base case? Like, what scenarios could happen to that stock price? And how did you really justify that? And then finally, you're going to wrap up and you're going to summarize your thesis and go into maybe a few risks. And I'm going to, in the next couple slides for this stock pitch section, go through like a very detailed stock pitch PDF that an investment club has done. But when you're in an interview, this whole process should take you maximum 3 minutes. Like, you have to be super succinct. There's a lot of detail in the next couple slides because I want to show you guys like what sort of information you guys should think about. But if you're vocalizing a stock pitch, typically in an interview, this whole process, again, should be very precise and to the point. You don't want to get bogged down in details. And again, the most important section is this investment thesis. What are your 3 points? So let's go into like a sample. So this is a stock pitch sample on Gilead. And again, here is what I mentioned. This is the executive summary. So you mentioned what stock you're pitching, your price target and implied upside, and your 3 bullet points explaining your thesis. So if you were to do an interview tomorrow and you had a pitch stock, like this first slide right here is 50% of what you would say to the interviewer. And then this next section is the industry overview. Again, a lot of information, but this is really good stuff. If you do a very, I guess, elaborate stock pitch for some reason, like for a school project or for an investment club competition. So here, the author talks about who are the key players in this market, what is going on in this industry. So in this pharmaceutical industry, you've got a lot of government regulation, high barriers to entry, who are the industries that buy from this business. So this is some of the information you could talk about. And then what's going to impact the industry going forward? This is pretty important. Is the industry going to grow or compress in the future? And so for this was a couple of years ago, but for Gilead in particular, which is a pharmaceutical company, the Affordable Care Act or Obamacare was a big driver in this business. And consolidation was a huge trend as well. And that was going to happen into the later years. So that was something the author talked about. And so the next part is actually the business overview. So again, what does this company do? How do they make money? What companies does the product sell? Those are some helpful things to think about when you're discussing a stock pitch with someone, especially if they've never heard of this business or if they never heard of this industry. You want to like really give them a picture of what this company does. So for Gilead, the investment thesis point number 1 is that they have advanced hepatitis C leadership, which is going to expand in the future. Their second point of this thesis was opportunities from drugs in the pipeline. So again, this PowerPoint has a lot of detail. If you were doing this in an interview, you would probably mention like very few bullet points on this page, and really keep it to kind of like the title points. And then for the for the fifth section of valuation, how you're getting your price target and upside. This author here did a discounted cash flow analysis, or DCF. I didn't talk about that. We went over multiples today, just since I think DCF honestly isn't used too much in equity research from my own experience. You see this a lot in investment banking, but from kind of the buy side and the fundamental side, we focus a lot on multiples. And again, a lot of accounting here, didn't want to get into it, but let's say from your multiples, you got your price target of $115. It'd probably be helpful, if you said, okay, like the best case, the bull case, if my estimates were too low, is we could get $130 price target, and bear case, or the worst case, if my estimates were too high and I was too optimistic, we get $92, which is a 10% downside. So you kind of go through those valuation scenarios in the stock pitch, just sort of at the very end, just to show you really did your thinking. And then finally, you wrap up with the potential risks to your investment thesis. And I would say, especially if you're in an interview, wrap up just like really summarizing this in 30 seconds again. Like once again, just to conclude, I'm pitching Gilead as a buy with the $115 price target and 13% upside because of its clinical trials, huge market position in hepatitis C, and dividends. And then that's it. So I think really like this flow here is super helpful if you ever have to encounter the situation where you do a stock pitch. Does anyone have any questions here on this section? I think I got something in the chat. Do equity research care about macroeconomic analysis like money supply, Fed fund rate, QE? That's a great question. So I think it really varies on what kind of firm you work for. For Capital Group, we are a very long-term investment firm. So we look at stocks on like a 10-year horizon. And if you talk to portfolio managers of capital, they're going to say to you, you can never predict the Fed. And so don't even try. We think about companies on their own individual level, and that's how we really generate stock returns. There are a lot of other firms like Bridgewater who do a lot of macro stuff, and they look at companies from the very top down, and they don't even like go into the financials. Like they look at industry only. So it's very unique kind of across firms. And I think it's also really unique across the sector you're covering. So for software stocks, there's not very much debt in the sector. So things like the interest rates don't really matter, but interest rates for businesses in the banking industry matter a ton. So for these kind of macro stuff, I think it really varies, but I'd say in general, not too much. But that's a really good question.
Hey, Jean, I also have a question regarding the stock pitch.
Yeah.
So when you're creating a stock pitch, do you recommend basing your thesis on a technical analysis or on a deeper fundamental analysis of the business operations, like you mentioned earlier?
Yeah, I mean, I think you could do either, but when I think about investment theses, they're more qualitative. So it'd be things like this product is going to generate way more revenue than the street predicts. There's going to be margin expansion, like better profitability from these initiatives. So kind of things like that. I'm sure you could like make complicated models to like estimate various aspects like that, but I think a lot of the technicality I've seen in stock pitches comes in the valuation section. So if you have like a super complicated, really interesting DCF model or some like multiples analysis you've done, I think that's where the technicality comes in. But I would say for the thesis, it's pretty fundamental.
Okay, awesome. Thank you.
Yeah, awesome. I'm gonna double check the chat. Okay, well, I think we have about like 10-ish minutes. I'm gonna wrap up with talking about careers in equity research. I guess just some like advice I'd give you guys. I think one, internships are really key to getting into equity research as a career, especially if you want to work for one of the bigger investment firms or investment banks. If for those of you guys who are heading into college, freshmen or sophomores, that junior year summer internship is the best pipeline that those major investment banks have into full-time offers. So, heading to the school year, really keep in touch with your career center on when these financial firms are recruiting on campus. It'll probably be virtual this year, but please stay on top of that. These things go by really quickly. I think almost all the major investment banks offer equity research or investment banking internships. Some internship roles for next summer I actually saw are already open. So, get on top of that. This stuff moves really quickly and it's competitive. So definitely don't fall behind. I think second, and I think this step goes for anyone, no matter what stage in your schooling or career you're in, start your own investment portfolios. It's super easy. You could do it on Fidelity or Robinhood. And it can honestly be as little as $50. I think, for this, a lot of times in interviews for equity research, they'll ask you, how have you demonstrated a passion for investing in an interest? And you can't just say, oh, I read the Wall Street Journal. That's great, but this actually shows that you have done the work. And I think when you invest your own money, it's very different than just playing around with a paper portfolio. You'll really learn your own investment style and what kind of businesses you're interested in. And it's a really fun way to see what kind of investor you are, and honestly, if you're good or bad at it. And third is join your school's investment club if you're still on campus. It's such a great learning experience. And I know some schools have big pockets of money they give students to invest, which is a fantastic opportunity. And it's a really strong networking experience. I personally was not in one in college, but I know a lot of people who were in the investment club at Berkeley got internships and jobs that way. And it's a fantastic experience as well. I think I had a question here. If you're going to personally invest in a stock, which one would you choose? One with proven track record and strong fundamentals, or future potential? That's a fun question. I guess it depends on your risk appetite, right? So maybe a couple of years back, you could say that Tesla fell into the latter bucket and not really the former. But if you invested there, you would have done really well for yourself. So yeah, it really depends on your risk appetite. I think ideally you would want a company that has both. How many sectors, industries do you think an equity research needs to focus on to achieve good performance? That's an interesting question. So for equity research, let's say at Goldman Sachs, typically what happens is you start off after college and you work for a senior analyst who is kind of the lead of the team. Typically you'll kind of stay in one sector for the first 3 years of that role. And then when you get promoted to vice president or the lead analyst, that's a huge opportunity. You'll typically go to cover your own sector. But on the buy side, it's a little different. So for investment firms that are actually investing in stocks, you see a lot of analysts that cover kind of multiple sectors. And if you're a portfolio manager and you manage millions and millions of dollars, you typically have mandates across various sectors. So you typically can't just be all tech unless you're in that kind of firm. So I would say early on, you're pretty focused. As you get more experience, your exposure gets pretty broad. Was there something specific you did to get a first relevant internship? So that first internship I got was at Goldman Sachs in New York City. That was a fantastic experience. It was really hard, but really challenged me. I think something I did, having a good stock pitch was really important, especially at Goldman. I think when you're so early on, I was in college, I had really little working experience. It was important for them to know why I wanted to do equity research, and having a good answer to that question in the interview is super important when you're young because you don't have that much of a track record. And I think for those kind of major investment banks, when you're doing that internship interview, they want to know why that firm. There are tons of firms hiring for the junior year internship, and you should have a good answer as to why equity research and why this firm specifically. So these are great questions. I'm going to go to my final slide, which is just some stuff I found for you guys. These are internship and learning programs I just dug up on LinkedIn and Google. Ernesto, do these people have access to the slides? I can just drop it in the chat later, if not, because I have links to these.
Yeah, so they actually don't have access to the slides. Okay. So if you could put it in the chat, that'd be super helpful.
Cool. For everybody. So these are some really cool programs I found. I've noticed that the investment banks are kind of starting to creep earlier and earlier into sophomore and freshmen. Still, it's mostly the juniors that they focus on in terms of summer internship hiring, but there's some really cool like leadership forums and events that these major banks have put out that are great opportunities. Like if you're a sophomore and you can get into this like emerging leader summit the next year for junior year when you're recruiting, you're like, oh yeah, like I know this person, this person, this person, and I know why Goldman because I had an amazing experience and made great mentors at this event. And so like just because these aren't internships doesn't mean that these aren't legit. Like these are really great ways to get exposure to what these firms do, kind of like what career paths you could have, and just to meet people for sure. Let's see. Why did you choose equity research over careers such as investment banking? That's a great question. I think investment banking is an awesome career path. You definitely are challenged and learn a ton. For me, it was a little selfish. Like I just didn't want to work those hours. When I was at Goldman, the equity research hours were pretty bad. It was like 5 a.m. to like maybe 9 p.m., but there was nothing based or versus what the investment bankers had to do. It just wasn't a lifestyle for me. I do think investment banking, if longer term you want a career in private equity or like venture capital, like you're dealing with firms that are like very early on who haven't been public yet, that is a great path to take. For equity research on a sell side firm like Goldman, you're looking at pretty much like only public facing stocks. And so that is a really good transition from that role to the buy side where you're actually investing stocks that are public. So I think there's just like kind of more of a parallel skill set for equity research to asset management versus investment banking to maybe venture capital. That's just personally. Let's see, there was a question someone asked that I forgot. I'll get to it later. How about work-life balance? How many hours do you work per week? So it really depends. I think especially for equity research on the sell side, where you are working for one senior analyst. And just to give you guys some background, like the senior analyst at a firm like Goldman, the way that they're paid is not, it's based on two things. One, it's based on how good their stock recommendations are. Like, did you recommend good stocks? Like if we actually invested money in your stocks, how much money would we have made or lost over the past year? Like that's, a computer calculates that based on the ratings you put out as a senior analyst. And then the second is you as a sell side analyst, you are trying to sell your research to investors at capital. Like let's say a portfolio manager, they're so swamped, they don't have time to do all this like deep work, but you as a sell side analyst at Goldman have done that work and you are pitching your ideas to them. So you will typically like be on the phone with people on the buy side, go to their offices before COVID, host the C-suite of companies and invite all these investors. Those investors at the end of each year literally do a vote as to who the best sell-side analysts are. And a lot of those soft skills and soft offerings are the way to get those votes. So that's like kind of how they're compensated. So that's a really long way of saying it really depends on your senior analyst. If there's someone who is really young and hungry and wants to like win, you're probably going to work a lot of hours. If there's someone who is maybe later in their career, they have kids, like they want work-life balance, like that's a whole different story. So it really depends on your manager. For me, it was at least like 13 hours a day, including Saturdays. This is not like a 9-to-5 job. This is not like a Google kind of lifestyle. This is hard work. And, but it's like super rewarding. I think both just intellectually and honestly monetarily. Like if you are good in this industry, you will be very successful. And if you like to be challenged, you like to push yourself, this is a great place to be. So I know we have, I'll maybe give like 5 more minutes, Ernesto, for Q&A. That's cool. Cool. There was one question someone asked that was really good. About private companies. Someone had asked a question about how do you evaluate IPOs? That's a good question. So on the sell side, so if you're at a major investment bank, you have these interesting incentives because let's say I worked on an IPO for ADT. You guys know the security company where like you install it in your house. They were IPOing a couple of years ago, and they chose Goldman to basically create the IPO for them. So as a research team, we worked with the investment bankers, and we're trying to get ADT to have as successful of an IPO as possible. So we want the share price to be high for them, right? Like that launching share price out of the gate. But that depends on like what the investors on the buy side actually think of the company. And so what we do is we would bring the CEO and the CFO to meet all these investors, like help them pitch their story and the financials. On the research side, what we would do is we would take an honest look at the financial data that the companies send over that no one else has seen. And we would kind of formulate our own model and write our own sort of thesis on the company. And it's different from investment banks because investment banking folks are trying to, get ADT to have as good of an IPO as possible. But on the research side, you want to have like a very neutral point of view, and you want to actually like make sure investors are making the right decisions. So you publish something that's very independent of what investment banking does. So that's kind of what we do on the sell side. On the buy side, where you can actually invest in IPOs. So I did a couple private deals at Capital. And what we would do is if a certain company had a Series E and they were like, hey, Capital, we're selling all these shares. Do you guys want in? And what we would do is we would get a ton of this like private data from them in terms of like their operating metrics, their execution, and we would kind of make our own decision based on that. And so that's kind of how it works. It's a little similar, but a little different at once. Where do you see yourself going after business school? It's a great question. I would be very open to going back into investing. I think it's a fantastic industry to be in. It's super exciting. But I'd also be open to doing something more operational, maybe doing strategy at like a cool tech company. I think for me right now, I'm staying pretty open. And if I find that, investing really was my calling, I'll go back to the industry. Cool. Let's see. Let me drop this file into the chat.
Okay, awesome.
Someone asked a question about getting referrals from analysts and PMs for portfolio management as a sophomore. If I had to warn you guys about something, I think, all of you guys being here shows that you're really eager to learn about this sector and how to get into it. But especially when you're younger, you need to walk a fine line between being proactive and frankly being annoying. So if you have like a decent relationship with someone personally, that's a great way to, like reach out to someone on LinkedIn, maybe someone who went to your school or who through connections. But I think as a sophomore, when you don't have too much like working experience, honestly, like use that as an opportunity to be like, hey, can I grab coffee with you and chat for you 20 minutes to learn about what you do day to day versus asking directly for a referral. I think referrals are mostly should be used for folks who know you like almost professionally. So I think those are more used like later on in your career. Cool. I'll take just this one last question. What do you think about coding skills like Python, SQL in this career? You don't need to get any certificates, but I think these are super valuable to have. I had a manager at Capital who was like very statistical, and I could not handle like the data projects he gave me, but learning things like R and Stata, I found like some analysts were really helpful. Python super helpful as well, but definitely like a nice have versus a must have. But I think in maybe a couple of years it will be a must have. Cool. Well, you guys, thank you so much for joining. I'm gonna just type my email into this box, and if you guys have any other questions or follow-ups, I'm happy to answer.
Awesome, Jean. Thank you so much once again for being here. I really appreciate it, and I'm pretty sure everybody else here really appreciates it as well. So awesome. Thank you so much once again. Thank you, guys. Have an amazing day.
Yeah, you too. Bye, guys.
Awesome.